Hi, I'm going to talk about something that came up in the news. It's regarding the $200 billion purchase of mortgage bonds by our government. I'm going to get into details and how that affects you. Well, let me just put this in context. This circle represents the entire mortgage market, which is $13 trillion of mortgages that are out there. Now, $200 billion represents this small, probably even smaller than this, okay? And this is only temporary. There's an infusion in the market. I'll go into it, but this is going to increase demand, which the intent is to have some sort of relief to mortgage rates. Now, this is temporary. So once this is gone, you're gonna go back to a normal market. Next, I'm gonna get into how the mortgage business actually works. Let's start off over here with the bank. The bank has $1 million to lend. You have borrower A gets approved for $500,000. Okay, now what ends up happening is that they get the $500,000. Now they have $500,000 left. That's the lender. Now, borrower B comes and says, hey, I want to get approved also for $500,000. They get approved for $500,000. Now the banks has zero funds. But let's say somebody else comes, this is borrower C, wants $500,000 also. Because they're doing well, they're getting good reviews, right? Well, the bank cannot lend at that point. So in order to solve for that, they created something called the secondary market. And what happens is that Wall Street, could be Fannie Mae, Freddie Mac, I'm gonna call it just Wall Street, actually does the bank a favor in a way where this bank now can sell Wall Street that $1 million in mortgages, and then Wall Street can then replenish the bank with another $1 million. Now, borrower C can now borrow $500,000 and they can continue and it becomes a cycle. Over here is the bank. They lent $1 million, they sell $1 million, then they get replenished with $1 million. That cycle keeps going. So they can continue to lend and the market for them stays pretty liquid. Now what happens over here is that Wall Street packages these mortgages into bonds, which are called mortgage-backed securities, okay? Now, in order to reduce the risk, what I mean by packaging is that, let's say there's 10 mortgages. Well, they package that all into a mortgage-backed security. The reason why they do that is that, let's say 2 people stop paying. Well, at least you have 8 that are still paying. It reduces the risk. Now, these bonds are very simple. They come with a maturity date. Okay, I'm gonna have a maturity, which is pretty much a term. So if you, as the investor, purchase these, okay, you're gonna get paid 6%. This represents the beginning, and this represents 30 years, okay? You're gonna pay 6% up until the end. So let's say if you came in with $1,000, you're gonna pay 6% for 30 years, and you're gonna get your $1,000 back. Now, the great thing about it is that it trades in the marketplace. All right, so let's say in year 5, you need some money, you sell it, and you get your money back. So what actually affects mortgage rates? Mortgage rates are affected by 3 things. Number 1, inflation. Number 2, market conditions. And number 3, supply and demand. Very simple, supply and demand. So let's go over inflation. Inflation is very simple, right? So let's say inflation is 3%. That means you're losing 3% of your money every single year. And if you go to the bank, you're gonna be like, you know what, you can't pay me 3%, you gotta pay me 4 or 5% because I have to catch up with inflation. It's the same thing with mortgage interest rates, right? So investors are going to expect around 7%. Because why would an investor take additional risk than having their money in the bank, right? And have an interest rate at 3%. They're gonna ask, that's called the premium, okay? So they're gonna ask for a little bit more. So in this case, mortgage rates will be around 7%. Market conditions, okay? If market conditions are bad compared to good, I'm going to just separate it this way. If the expectation that market conditions are going to be bad, usually interest rates are going to go a little bit lower. And the reason is that they're going to try to stimulate the economy. So a way to stimulate the economy when market conditions aren't looking too good is to decrease rates so that they can stimulate demand. And it's also long term, if they are able to see that rates are going down, then what's happening is that a lot of investors have a negative outlook about the future. Now, if things are good, right, usually what happens is that rates go up, because what happens when things are good, things get overheated, right? And sometimes that can lead to inflation because there's a lot of money circulating in the economy. So number 3 is supply and demand. I know that word is used a lot, but let me explain how it relates to mortgage rates. It's very simple. Let's say you start off with a baseline of 6% and demand actually increases, right? Well, if demand actually increases, that means investors want this. That means you can say, oh, if demand increases, let's try 5.5%. Demand is still the same, 5%. Maybe demand starts decreasing and you realize that you reach an equilibrium at 5%. Now that's set at 5%. Now let's say demand decreases, right? Demand decreases, is more supply. That means investors are like, they're not demanding so much. Supply is increasing. Now instead of the 6%, you have to offer 6.5%. There's still not enough demand. Let's go up to 7%. And maybe you reach an equilibrium at 7%, and then the market rate gets set. So the great thing is that we have a frame of reference back when there was COVID. So when there was COVID, what ended up happening is that the Federal Reserve printed money and actually purchased a third of a $13 trillion market. So imagine them buying a third of the market artificially. They were just buying a third of that market. Now, remember we went over supply and demand? What do you think that's going to happen? Okay, demand is going to increase, right? This represents demand. Therefore, interest rates would go down. So remember we had rates at 2.5%, 3.5%. It was artificially created because they created more demand to the marketplace. Now what ended up happening was, I remember I went into market conditions, and usually if rates go down, it's going to stimulate the economy. Well, the economy stimulated so hot that all of a sudden inflation started creeping up. Everybody understands inflation and how bad it's been the past 3 or 4 years, where they had to stop doing this. And then the interest rate actually set itself at where it was supposed to be. That's what we're doing right now, 6%, 6.5%, without manipulation. Compare that to the 200 billion, it's only this much. So at the end of the day, the 200 billion is not going to affect the market. So in summary, mortgage rates are impacted by inflation, by market conditions, and supply and demand. What they're not controlled by is when you see in the news when the Federal Reserve is going to make an announcement to reduce interest rates, that is not mortgage rates, okay? That is the overnight rates that banks are going to lend money to each other. That has nothing to do with mortgage rates, okay? And number 2, they're not controlled by the president or by politicians. It's those 3 factors, again, unless they're doing some sort of manipulation, which creates inflation.